You are carrying a 3-digit summary with you right now. It dictates where you can live, what you can drive, and whether you can fully participate in the modern economy. You check this score constantly. You celebrate when it goes up slightly, and you panic when it drops. But the number you are staring at is not the actual metric that lenders use to judge you.
It is a pacifier. That 3-digit score is just the cover page. It is a highly compressed, sanitized version of your financial identity, designed specifically for consumer consumption. The system gives you this simple number because it gives you something easy to track. It gives you the illusion of control.
While you are busy managing the cover page, the bank is reading the vault. Behind that simple score exists a massive, highly detailed shadow file. This is the document the lender actually looks at when you apply for capital. It does not just list whether you paid your bills on time, it tracks your behavioral trajectory, your hidden risk flags, and the velocity of your debt.
It is a psychological profile disguised as an accounting ledger.
Everyone knows about the big 3 bureaus: Equifax, Experian, TransUnion. You are taught that these 3 entities hold the entirety of your financial reputation. You freeze your credit with them, you dispute charges with them, and you monitor their reports.
But the big 3 are just the primary layer of a much deeper surveillance apparatus. They are just the surface level.
Beneath them exists a secondary layer of data brokers that you likely have never heard of. Companies like LexisNexis, Innovis, and CoreLogic. These institutions do not just track your credit cards and your mortgage,
they sweep up the exhaust of your daily life, assembling the pieces that the primary bureaus leave behind. They are building a shadow network of your behavior. They track your utility payments, your rental history, your cell phone bills, and your property records. They know if you have ever been evicted. They know if you have disputed a medical bill.
They know if you frequently change your address. They are building a behavioral model of stability, and they are selling it directly to the banks. When a lender pulls your file, they are looking for silent triggers in this secondary data. A high credit score can mask underlying distress, but the secondary bureaus will flag the distress before you ever miss a credit card payment. If you start paying your electric bill 2 weeks late, the system notices the shift in your cash flow immediately.
The algorithm understands the domino effect of financial collapse. People typically prioritize their credit cards last when money gets tight. They pay the rent first to keep a roof over their head, and the utilities second to keep the lights on. If the secondary data shows friction in the foundation, the lender knows the credit cards are going to be the next thing to fall. Your 3-digit score might still look perfect, but behind the scenes, your internal risk rating has already been downgraded.
You walk into a bank expecting a premium interest rate because you have never missed a primary payment, and you are quietly denied. You are denied based on a file you did not know existed, reading data you did not know was tracked. Furthermore, if you hold your checking account at the same institution that issues your credit card, they do not even need the secondary bureaus. They have a direct feed into your cash flow. If you overdraft your checking account, the risk department sees it instantly. The credit card side of the bank will quietly lower your limit to reduce their exposure. Beyond the shadow data, lenders scrutinize the velocity of your debt. The consumer score treats a balance as a static snapshot. The algorithm treats it as a moving object. It is not just about how much you owe. The algorithm tracks how fast your debt is growing relative to your historical baseline. If you suddenly max out 2 cards in 1 month, your consumer score will drop. But the underlying file triggers a much more severe internal alarm. The system identifies a sudden spike in utilization as a behavioral crisis. It assumes you have lost your primary source of income or suffered a catastrophic medical emergency. This analytical approach is known as trended data. For decades, lenders only saw what you owed at the exact moment they pulled your report. Now, they see up to 24 months of your exact payment amounts and balance histories. They see if you are paying your balances in full every month, or if you are just paying the minimum required. If you are only paying the minimum, the algorithm classifies you differently. You are profitable, but you are exceptionally fragile. You are generating massive interest revenue for the bank, but you are 1 medical bill away from default. The lender loves the profit you generate, but they will ruthlessly cut your credit limit the moment the macroeconomic environment shifts. Then there is the opposite end of the spectrum. the person who pays their balance in full, every single month, without fail. In the consumer narrative, this is financial perfection. This is the ultimate goal of personal finance. In the internal language of the credit card industry, this person is known as a deadbeat. It is a genuine industry term. A deadbeat is someone who uses the bank's capital for 30 days, collects the reward points, and pays exactly $0 in interest. You are a net negative to their balance sheet. They lose money facilitating your daily transactions. The system gives you an excellent score, but it restricts your access to the most lucrative limits because you do not pay the toll. The ideal customer is not the perfect payer. The ideal customer is the revolver. The revolver carries a high, consistent balance, but always makes the payment on time. They are bleeding cash in the form of interest, providing a steady, reliable stream of revenue to the institution. The entire banking system is designed to identify and reward revolvers. The algorithm maps you on a matrix of risk versus profitability. The highest consumer score indicates low risk, but also incredibly low profitability. The sweet spot for the lender is a slightly lower score. Someone who has shown they can handle the debt, but is willing to pay heavily for the privilege of holding it long term. Every time you ask for more capital, the system records the request. This is known as a hard inquiry. You are taught that inquiries drop your score by a few points, which is a temporary penalty. What you are not taught is how the algorithm interprets the velocity of those inquiries. The broader context of the request changes everything. If you apply for an auto loan and the dealer submits your application to 5 different banks in one afternoon, the system groups them together. It knows you are shopping for a single depreciating asset. It understands the context. The algorithm ignores the sheer volume of inquiries because the specific intention is clear and the risk is contained. But if you apply for 3 different credit cards in 3 days, the algorithm flags it as desperation. It assumes a hidden liquidity crisis. It assumes you are trying to outrun a collapsing balance sheet before the other lenders notice. The score might only drop 10 points, but the internal risk flag goes bright red across the network. You will be instantly denied for the 3rd card, regardless of what the 3 digits say. The algorithm is guarding the gates against sudden panic. Lenders know that when consumers realize they are out of money, they attempt to secure as much unsecured debt as possible in a very short window of time. The algorithm is built to stop the run. Then there is the illusion of the authorized user. People try to hack the system by grafting themselves onto someone else's pristine credit history. The score shoots up immediately. The consumer feels like they have successfully bypassed the wait and beaten the system. But the modern underwriting algorithms strip the authorized user data out entirely before making a final decision. The score includes the grafted data, but the actual file strips it out completely. When you apply for a mortgage, the underwriter looks right through the grafted history. They isolate your organic behavior. If your organic file is thin, the artificial boost from the authorized user will not save you. The system is too sophisticated to be tricked by its own display metrics. Your file also contains geographical risk clustering. The algorithm looks at your exact zip code. It looks at the default rates of the people who live directly around you. If you live in an area experiencing rapid economic decline, your individual behavior is weighed against the systemic risk of your surrounding environment. You are essentially found guilty by association. You might be paying everything on time perfectly, but if your neighbors are defaulting, the lender assumes you are facing the exact same macroeconomic headwinds. They will quietly tighten your limits. They will lower the ceiling on your potential capital. They are managing the risk of the neighborhood, and you are just a single data point within that geography. There is a massive difference in how the algorithm views the type of debt you carry. A balance on a premium travel card is viewed differently than a balance on a subprime retail store card. The system judges the financial sophistication of the borrower based on the specific consumer products they choose to utilize. Not all debt is created equal. If your file is filled with low-limit consumer financing and payday loans, the algorithm categorizes you as a high-risk, low-sophistication consumer.
even if your payment history is mathematically perfect. The lender knows that sophisticated borrowers use cheap capital to build wealth, while desperate borrowers use expensive capital just to survive. The file reveals the profound difference instantly. The system does make specific exemptions, but not out of compassion. Medical debt is weighted differently than consumer debt. If you have a massive unpaid hospital bill, the algorithm knows this was likely an involuntary expense, not a sign of reckless consumer spending. It discounts the medical debt, but it still records the severe strain on your overall cash flow. The most dangerous part of the shadow file is that you cannot easily dispute what you cannot see. If a primary bureau reports a late payment incorrectly, you can file a formal dispute and have it removed. But if a secondary algorithm categorizes your spending patterns as indicative of impending default, there is absolutely no form to fill out. There is no customer service line for the internal risk matrix. You are simply denied. The rejection letter will list a vague, legally compliant reason like insufficient credit experience or proportion of balances to credit limits is too high. It will never tell you that the algorithm spotted a shift in your utility payments and deemed you fundamentally unstable. The entire architecture of the credit system is predictive, not historical. The consumer looks at their score as a grade for their past behavior. I was good, so my score is high.
But the lender looks at the file as a weather forecast. They do not care that it was sunny yesterday. They only care that the atmospheric pressure is dropping rapidly. The algorithms are designed to protect the bank's capital before the storm actually hits. If the shadow file predicts rain, the bank will pull the umbrella away while the sun is still shining. They will cut your limits. They will close your inactive accounts. They will reduce their exposure to you long before you even realize you are in serious financial trouble. One of the greatest misconceptions is that a high income completely solves the credit problem. It absolutely does not. The credit file does not track your income. It tracks your financial obligations. A massive income paired with massive, highly leveraged debt presents a very specific kind of systemic risk to the lending institution. The algorithm respects the margin, not the gross revenue. A borrower making $50,000 a year with zero debt and a 20-year history is incredibly stable. They are infinitely more predictable than a borrower making $500,000 with rapidly shifting liabilities. The system values absolute predictability above all else. Predictability can be mathematically modeled. Predictability can be securitized, packaged, and sold to global investors. That is the ultimate destination of your personal financial data. Securitization. Your specific loan is bundled with thousands of others, sliced into risk tranches, and sold to global investors. The shadow file exists to give the rating agencies immense confidence in the bundle. The algorithms must be ruthless, because they are actively defending the integrity of trillion-dollar bond markets. You are not just negotiating with a friendly local bank manager. You are interacting with the sensory inputs of global capital. When you swipe a card, when you pay a bill, when you change your address, you are feeding the machine. It digests your behavior, categorizes your risk, and prices your access to the modern economy accordingly. The 3-digit score is simply the game they allow you to play. It keeps you engaged. It keeps you checking the app. It keeps you striving for an arbitrary 800. But the 800 is just a psychological milestone. It means absolutely nothing if the shadow file beneath it shows fragility. The real game is entirely invisible to the consumer. To successfully navigate this system, you have to stop playing the score and start playing the algorithm. You have to actively manage your velocity. You have to maintain your stability across all layers, not just the primary ones. You have to understand that every financial move you make is being constantly recorded, analyzed, and weaponized against your future access to capital. The system is not evil. It is just entirely indifferent to your personal narrative. It does not care about your excuses. It does not care that you were only late because of a technical banking error. It only cares about the mathematical pattern. You are a profile, a cluster of data points floating in a massive matrix of risk.
You are paying a massive, invisible toll every single day just to exist inside the modern economic framework. The shadow file is not just a record of your past, it is the master key to your future. It determines whether you get the loan, what rate you pay, and ultimately, how fast you can accumulate real wealth.
The next time you open your banking app and look at that bright, friendly 3-digit number, remember what it actually represents. It is the cover of a book you are not allowed to read. It is the summary of a trial you were not invited to attend. You are seeing exactly what the machine wants you to see. What is the machine hiding in your file?